Good day, ladies and gentlemen. I'm Adrian Douglas. I'm a market analyst and a member of the board of directors of the Gold Antitrust Action Committee. I'm going to talk to you today about gold and silver market rigging. I'm going to show you the motivation for this market manipulation and how it is achieved. But more importantly, I'm going to show you from some statistical studies that I have performed that this market rigging is entering its endgame and is now unsustainable. The motivation for the manipulation of the gold price is to keep US interest rates artificially low, the purchasing power of the dollar artificially high, so that the US can live beyond its means. To understand the mechanism of how this is achieved, we need to understand the relationship between the US dollar and the US gold reserve. It's often stated that the US dollar is issued out of thin air and backed by nothing. This is not entirely true. If we look at the annual report of the Federal Reserve, we find that the collateral against which the Federal Reserve notes are issued is the gold certificates, which are quoted on the annual report at around $11 billion. If we take the official gold price of $42.2 per ounce, this translates to 261.5 million ounces of gold. That is to say, all the gold of the US Treasury. So the total gold reserve of the US Treasury is the collateral against which Federal Reserve notes are issued. The Federal Reserve note, however, is not redeemable against these gold ounces because the gold window was closed by President Nixon in August of 1971. If we look at the total amount of Federal Reserve notes that have been issued, a number known as M3, which is approximately $14 trillion, and the total amount of gold of the US gold reserve of 261.5 million ounces, which is the collateral which backs them, we can calculate that the gold price, in theory, should be $53,500 per ounce. The fact that the gold price is not $53,500 is due to market manipulation, which we will see the mechanism of that in a moment. Once the dollar has been determined from the M3 and the gold reserve at $53,500 per ounce, the dollar cannot be traded in the free market to discover a different price. But what can be traded is gold and paper gold, and the average price of pure gold and paper gold determined as long as buyers accept paper gold as identical to pure gold. This is the principle of fractional reserve bullion banking, where bullion sales are only partially backed by real metal. Let's illustrate the principle of fractional reserve banking with an example. If a bullion bank sells 33 ounces of unallocated gold, the buyer believes that he's actually bought real gold. At a gold price of $1,600 per ounce, the buyer will pay $52,800 for his 33 ounces of gold. The gold, however, is only partially backed. Let's say that only 1 ounce is actually backing the sale, which means that 32 ounces don't exist. This means that the 1 real ounce that the buyer has bought costs $52,800. This is about the same price as we calculated for the gold price based on the gold reserves and the amount of M3 that has been issued. This means that the $1,600 gold price that we currently have can be achieved from a fractional reserve gold bullion banking system if 1 ounce is backing every 33 ounces that are sold. In other words, about a 3% backing of the gold being sold. The bullion bankers are running a dangerous game as the viability of fiat currencies comes into question. The demand for physical gold will expose the fractional reserve banking and drive prices to unprecedented levels. Another factor that may drive US gold prices much higher is the possibility that the US gold reserves have been sold or encumbered in some way. This is why it is critically important that there is an audit of the US gold reserves, which is something that has been advocated by G.A.T.A for quite some time. We've just seen that in a fractional reserve gold banking system that a gold price that should be around $53,000 per ounce can be suppressed to around $1,600 per ounce with a fractional reserve backing of around 3%. The question is, though, how can 97% of investment capital be shepherded into unallocated gold? The answer is through volatility and a downward bias on the gold price. If there is volatility, investors want to be able to enter and exit their positions rapidly. Unallocated gold can be entered or exited in a matter of seconds, while real bullion positions might take days. The question is, how can volatility and a downward bias on the gold price be achieved when the market is meant to be freely traded and prices fixed through a relationship between supply and demand in a process which is known as the London fix? The answer has to be that the London fix itself is manipulated, and we'll see in a moment through statistical studies how this actually is the case. This chart shows a statistical study that was performed on the AM and PM gold fix between 2001 and 2011. Two traces are shown on this chart. The first one is the blue trace, which is scaled against the left-hand side and is the cumulative overnight change in the gold price. This is effectively the portfolio result that you would get if you had purchased gold every day on the PM fix and sold it the following day on the AM fix. The second trace is the red trace, which is scaled on the right hand side. This is the cumulative intraday change into the gold price, which is essentially the same as the result that would be achieved if one were to purchase gold every day on the AM fix and sell it on the same day on the PM fix. What this chart shows is that if we had traded gold overnight over the 10-year period, we would have made money and around $1,700 per ounce. However, if we had traded on an intraday basis, buying on the AM fix and selling on the PM fix every day, we would have lost $500 per ounce. This is absolutely phenomenal and completely shocking, and can only be explained by manipulation. Clearly, as the gold price rises, the PM fix is being sold down to contain the gold price rise. However, in recent months, as shown by the dashed line, the sell down in the PM fix has stabilized, even in the face of an accelerating gold price. I'll talk about the significance of this in a little while. This chart shows the same data but displayed in a different manner. It cross-plots the cumulative intraday gold price change against the cumulative overnight gold price change. What is immediately surprising is to see that they are correlated in a linear fashion such that the data sets fall on a straight line. This means that as the gold price rises, the PM fix is sold down more and more and in a way that is linearly related to the rise in the gold price. What this shows is that the more the gold price rises, the more the PM fix is sold down, and that there is a mathematical relationship between the two. This can only be the result of manipulation and not the result of a free market. As pointed out on the previous slide, there are signs that the manipulation is running out of steam. Over the last few months, the cumulative intraday change has been static while the gold price has increased. This may be an early indication that the cartel is entering the end game and is not able to suppress the gold price as they have in the past.